Yeah, hi, I'm Luke Alexander, President and CEO of Newcore Gold. Newcore is advancing the Enchi project in Ghana. It's an advanced stage district scale project. We've got a 1.4 million ounce resource today. We are in the process of updating that, looking to get those results out in the next few weeks. The company's fundamentally underpinned by robust economics. We put a PEA out in 2021, which outlined an after-tax NPV of 212 million at a 1650 gold price. So there's a fundamental underpinning of value for Newcore. It's backed by a very strong team with a proven track record in the mining sector, who are also importantly very well aligned with shareholders. We own 24% of the business, so we think as shareholders first. We also have very strong institutional support, currently 40% owned by deep-pocketed, long-term focused mining investors who recognize the value that there is within the Enchi project, as well as capital market support. We currently have 5 investment banks who cover us from a research perspective. So district scale exploration that's fundamentally underpinned by a resource, a PEA, and is very well supported by management as well as the capital markets and institutional investors.
I think that's it, really, folks. I've got no questions. No, how? Right, let's talk about this. You're ex-analyst, ex-banking, so you laid out a beautiful story there. But for people kind of looking in, I'm not sure they do understand the value and the metrics that you're using around those values, right? 35 million market cap, that sort of level. Share price has kind of held its own for the last while, and 2022 was hideous for everyone, right? But even in that sense, you kind of held your own. But it's at PEA stage, so obviously they're looking for more certainty coming through with PFS whenever that feeds in. And for you, the scale isn't there. Like, it's not big enough yet. There's a lot of projects of your size in West Africa and elsewhere in the world, and they need you to do more. You need you to move more. So what are you going to do about it?
So I think one of the unique things that we've got with our Enchi project is optionality. Mm-hmm. Because it's a heap leach project, I'll get into a little bit more of the economics. So heap leach project, CapEx of $100 million, as I outlined, after-tax NPV of 212 million at a 1650 gold. Let's use 1850 gold. You're at a $300 million after-tax NPV. So your NPV of the project at 300 million relative to your CapEx of 100 million is a very attractive project. That's one of the big reasons we've been able to attract such strong institutional support. So there is a project sitting there today that could be built and create very good cash flow for the company, which can then be redeployed into exploration to ultimately grow the overall size of the resource. So the fact it's a heap leach project, that's one of the big differentiators for the company. So that project sits there today. We are in the process of doing a lot of de-risking to move that towards a production decision. So we've just completed or in the process of completing a baseline study. That's one of the key things required to get a mining permit. We've released results from 7 column tests, so we've got a lot of confidence in the recoveries from a metallurgy perspective. But we are continuing to de-risk that as well. We're in the process of kicking off 2 bulk samples, which will give us even more confidence in the metallurgy. So all of these de-risking things are happening in the background. With the resource update that we're doing at the moment, one of the things that we think we're going to see is a lot of the inferred ounces move into the indicated category. That's another important de-risking step to ultimately move it towards a production decision. So that's kind of one of our options is today 100,000 ounces a year over a 10-year mine life. That's a very attractive project for us to potentially build, or for a small maybe single asset producer or small mid cap who sees that I can bring 100 100,000 ounces of production in. I can then ramp that up to 150, continue to aggressively explore, take the cash flow from that, invest that into a CIL plant as we get into the sulfides, and ramp that up to 2 to 250. So that's one thing that we're doing and continuing to work on. The other is obviously we've got a very large project, so 216 square kilometers in size. We've identified 25 targets across the property. We've drilled 9 of them to date, and 4 of them currently hold our 1.4 million ounce resource. Last year, we made 3 new discoveries on the project. So again, that further highlights the district scale opportunity. We started to drill a little bit deeper into the sulfides for the first time ever, drilling below 125 meters. We had some very good high-grade intercepts. So one of the things that we're expecting with this resource update as well is that for the first time ever, we're actually going to be able to wrap a resource around some of the underground material, maybe 50 to 100,000 ounces. So with that, it's not an underground mine at that stage, but what it is proof of concept that, look, these greenstone hosted deposits along the Sefwi-Bibiani belt, they extend at depth and increase in grade. So our ability to start to showcase some of that is important. So option 1, de-risk the project to a production decision. But the other option, and we're doing them in tandem, is continue to aggressively explore on the project and grow those overall ounces.
Right. So here's what it comes down to. You're talking about 100,000 ounces a year for 10 years. That's great. That's a nice project. But when you talk about plowing that back in the ground to release future value, there's a kind of time horizon there. So the conversation then switches from, we're cash producing or net cash producing, through to value creating. People aren't quite sure where you're sitting, right? So this is what I mean about how do you differentiate yourself from all the other stories saying very similar things to you, going through the admin of de-risking. That's all it is. But there's no kind of big emotional blue sky reaction here from the market at the moment saying, do you know what? I feel this could be $1 billion company. I like the model that they're going to create here because early cash, less dilution for me, and will eventually, at some point, create a really valuable company by finding more ounces in this massive land package that we've got. So it's a lot of moving parts for people to understand. It's a strategy which people, I'm not sure if they either have been listening or understand it, or perhaps they are discounting it because you're going to plow the money straight back in the ground. So do you change tack? Do you simplify it? Do you say, well, actually, maybe we have some monetizing moments with the rest of our asset at some point? How do you change the story so that people get it?
Well, so I mean, if we look at the amount of stock that we traded in Q4 of last year, and you look at some of the buying that came in to mop up the stock, I would say we actually do have a lot of investors who see what we're doing on the ground, recognize that we've done everything we said we would from a exploration perspective, as well as from a de-risking of the project perspective. And that's why they continue to, be very supportive of the company and recognize that, in a market in 2022, where you've got, companies like Newmont who are off over 50% from their 52-week highs, that, exploration companies like Newcore are going to sell off more. And, we got caught up in that along with the rest of the junior sector. But the fact that, we traded a third of the volume of the stock, and our existing institutional holders, a number of them came in and added to their positions, recognizing the fundamental value that there is in the project with the significant upside potential. I would say that, there has been a lot of buying and support for the company, and lots of investors do recognize the value that there is in that optionality that we just outlined. yes, we can build this to 3 to 5 million ounces. If you look at the other, deposits that there are along trend from us, Chirano at 5.5 million and growing, Bibiani at 6.5 million, Newmont at 20 million ounces. Those are all deposits that, with historical and current endowments that sit along the Sefwi-Bibiani belt from us. And, we have been continuing to move towards, growing the overall size of it. But at the same time, if we can be de-risking the project towards production, and someone comes along and says, hey, we love this 100,000 ounce heap leach project and we want to buy it, then that creates value for potential value for our shareholders. Or we decide that, hey, we can fund this ourselves and we want to build it while continuing to aggressively explore and expand the overall resource, then why not create that optionality?
But are you what he was saying here, you're sort of victim of timing, because there's some case studies there. There's some companies there who have done it a certain way and been valued accordingly. I go chase the answers. It's the Canadian way, it seems, right? But you've come up with this. Well, actually, we'll create a kind of product here in this 100,000 ounce 10-year project that someone may want to come along and pick up. So there's some interest there. But you're not getting value for that versus these guys who've kind of done it. Maybe their timing was better in the sense it was earlier in the market and gold was doing its thing, and it hasn't been a pretty environment for gold for the last, I'm going to say 2 years now, right? 2 years?
Yeah, no, it's definitely been a tough environment since 2021, 2022. It's been a tough environment, but again, we've been able to continue to raise money. We've raised $34.5 million over the last 2 years. The investors, again, that have come in and looked at our project in detail, and they're, in the business of having to look at projects all around the world and comparing, each of those projects with ours, and they're keen to continue to see us aggressively drill and move it forward.
Well, let's look at that, okay? Because that's important. Because I'm saying there's companies here have got used a business model which has worked for them.
Yep.
You could do the same, or maybe you should have done the same, but you've chosen a different path. Yes, money's easy to come by. It's the cost of that money. You got to question that. The type of money, yes, you're turning over stock, and that's good. And liquidity is really important for driving price. And you have held your own in 2022 in a pretty shitty environment, right? That's the truth. But what's the kind of pushback that you're getting from holders now? What are they concerned about? What do they think you should be doing that you're not? Could be doing?
So I guess in terms of when you reference other companies going with this strategy, I assume you're referring to the Canadian strategy of grow it as big as you possibly can. Absolutely. And then turn around and sell it. Right. So I mean,
well, also some of the people in the region.
But just to kind of avoid any potential confusion on that point, we are continuing to aggressively drill, and we will continue to grow those ounces towards what we've always said is we see that there's, a 3 to 5 million ounce plus potential here. And the reason we talk about 3 to 5 million ounces is that, at that stage, you're producing 200,000 ounces over a 15 to 25 year mine life. That's the kind of size and scale that becomes attractive to, majors and large mid-cap companies. So we are continuing to do that, and that's one of the options that we've got, and something that we will never lose focus on. But at the same time, if for our investors, without spending a lot of capital, we can do all these de-risking things for the 100,000 ounce project that we've outlined. Then why wouldn't we do that? Because that just creates optionality. So we are focused on the big exploration upside, but at the same time, in the background, we're de-risking the project. But
that's the bit, right? You say, but saying that I've got this cash generative asset potentially. I just need to raise the capex, go through the de-risking thing, do the economics, raise the debt equity, whatever that mix is, and it will be cash generative, which releases the future value of this massive land package that we've got, as long as we understand what it is that we're chasing. All these other ounces we can release the value on in a 1870 gold market. That's the bit I think people are not quite sure on. Well, it seems to be somewhere we get a lot of inbound. So what is the potential of the rest of the land package? How do you get to 3 to 5 million ounces with your cash balance?
Well, continuing to drill.
But you continue to raise as well, right?
Yeah, I mean, as an exploration company, that's the reality. I mean, any exploration company who comes on this on this show or is interviewed by you at some point needs to raise more money
But
to
at higher and
ultimately.
higher prices, and that's the thing. So I'm saying you got to get that kind of tension going for people to say, there's the growth, there's the blue sky. They've done it before, they can do it again, and the end goal is 5 million ounces.
Yeah.
I can wrap my head around that.
Yeah.
So is that the challenge for this year? What's the focus for this year?
Well, so the focus for this year, again, we're in the process of getting this resource completed. So on the back of that, we'll have additional drill results that are coming out. So we're drilling at the moment.
What type of drilling is it? Are we bringing inferred into indicated, or are we looking to build more ounces?
So the drilling that we're doing at the moment is some of the deeper drilling down to kind of 300 to 350 meters, targeting some of the higher grade material that we've encountered on the project
more ounces,
today.
higher grade. That's what we're looking for.
Yeah,
that's a nice story.
Yeah, and so that what we have with the higher grade material that we've discovered so far on the project is we've got these high grade shoots that we see all the way along the Sefwi Bibiani belt. As part of the 90,000 meter drill program that we completed, we made a number of high grade discoveries, kind of anywhere between 150 and 300 meters. Right. So that's the piece that I was talking about, where with this updated resource, we think given the density of drilling in a few of these areas, we're going to be able to wrap some ounces around that and include them in our resource. So follow-up drilling on those, discoveries that we've made is something that we're obviously
define discovery for me
right now, in terms of.
Well, how do you define it? Every company's got a different way. So we've made a discovery, which is a great headline, but what's it mean?
Well, so I think, making a discovery and then actually being able to wrap a resource and add ounces is important. Because, some people go, I made a discovery. Well, yeah, but, it's it's one hole a kilometer away from your main deposit. Whereas this actually is now, a concentration of drill holes that starts to highlight the fact that there's underground mine potential at our project. Okay. So, following up on that discovery and looking to expand the overall, size of that discovery so that you grow the ounces is something that we're focused on with some of this deeper drilling that we're doing.
Okay, so 1.3 goes to, what do you think it needs to go to
kind of get noticed? We're at 1.4 million ounces today. If you look,
all categories.
Well, right now it's only inferred. Okay. So that's one of the things that we're expecting is, a bunch of the drilling that we did as part of the 90,000 meter program was at our existing resource areas. So stepping out along strike, looking to expand the overall size of the mineralized footprint, which then obviously expands the overall size of the pits and adds ounces. But what we also focused on was some up dip and down dip drilling. So where we saw material potentially not being pulled to surface and captured within those pits, which then feeds into the resource, we drilled up dip and down dip. And what we're seeing is that with a lot of that up dip, down dip drilling, along with the, other holes that were drilled, we're getting, kind of 25 to 30 meter spacing. Once you start to get that kind of spacing, that's where you can move inferred ounces into the indicated category. So our view is, let's say we ended up at, 400,000 or 500,000 ounces of indicated, just to pick a random number. At that point, you've now, de-risked 4 or 5 years of 100,000 ounce a year production. One of the things we're obviously going to spend a bunch of time on once we do get this updated resource completed and we have all of the numbers and where the indicated sits relative to the inferred is, does it make sense to take it from maybe 400,000 to 500,000 ounces to, 800? And then you've, outlined, 100,000 ounces over 8 years. But one thing we aren't going to lose focus on is that 3 to 5 million ounce potential that we see all the way along the belt. But again, from a de-risking perspective and, from a corporate perspective, those are very important de-risking milestone. So, the conversations that we have with potential retail investors or other investors relative to the conversations and what's important for a corporate acquirer or business development teams from a lot of these companies are often very different. So, one of their first questions is, what's the recoveries in the met? What are the indicated ounces? What's the ability to get a mining permit? Baseline studies, all that kind of stuff. So I get it that that might not be important to investors as public market investors as much, but for business development teams, for all of these corporates, those are the most important.
It's literally
things.
Where I was going next, was because you've got two things to manage. Management hold a ton.
Yeah.
You've got a bunch of institutional there, and because I think the coverage helps you with that one, and retail as well. And the understanding is different. The drivers are different, and the way that they value you is different. But it's important for you as a company to kind of you're driving. Turning over a third of your shares is amazing, but it's like whose hands that's landing up to. You talked about mopping up, so it suggests like deep pockets or mopping that up. The retail, I can see why perhaps this isn't giving them the kind of the movement which they desire of some of these investment stocks here. So, but if you're building a company and building a story for the kind of institutional and industry players, you're going to behave a different way. You're going to signal to the market a different way, and that explains why you've done things the way that you have. So, what's important for you this year in terms of messaging to the market for retail? What do you think that they want to hear, and what is it that you think they should want to hear? Because there's two different things going on at the moment.
Yeah. So, continued.
Because can I just say,
yeah.
I think retail want you to come out and say, "Hey, we've got a 5 million ounce project in West Africa. That's suddenly interesting and meaningful, or at least we've got a path to building those ounces. So that's where we're going to come and ask you for money for, right? That's what they want to hear. It's as simple as that. Big company potential.
And if we go back to the first interview that you and I ever did, that was stated. Our goal is to build this to 3 to 5 million ounces, back to the 200,000 ounces, 15 to 25 year mine life. And, so that has been something from day one.
And that hasn't gone away. You're saying that hasn't gone away.
No. I mean, if you look at it, we've drilled, our resource sits on 4 out of 25 targets across the property. We've still just scratched the surface from a, drilling perspective in terms of depth. If you look at, let's take it as a percent of our overall, we've drilled on maybe 15% of our overall 216 square land package. You look at, where the mineralization sits on the Sefwi-Bibiani belt. You've got the main Bibiani shear that comes off, and then you've got these second and third order splays that come through our property. You've got 100 kilometers of, these second order splays coming through the property. So, there's huge exploration upside, but, you need to systematically drill it, grow the ounces, drill it, and continue to grow the ounces. So that's, a big opportunity for us. If you look at the average vertical depth of the pits that hold our 1.4 million ounces today, it's only down to 63 meters. That's insane. So, it's 2/3 the length of a football pitch. If you look at, most of these, again, to compare it to Chirano or Bibiani or a Ahafo to the north of us, Chirano at the moment is mining down at 800 meters below surface. They've drilled down to 1.1, 1.2, so 20 times the depth of where our current resource is captured. And let's put that
into English for people, which is basically, with your project, the cost of accessing that ore is de minimis. So grade ceases to become a conversation. What we're talking about now is margin. Your margins have significantly increased compared to certainly the example that you gave. And that's important. That's why the institutional guys are important. That's why the industry players find it interesting to them, because they feel that they can make money here. Understood. But let's stick with. I want to help the retail guys watching this. All right. So they're going, I want a ton of ounces. You said we're going after a ton of ounces. Don't worry about it. Okay. But what we've got is we've inserted this mechanism here, which will reduce the future dilution of this company because it will throw off a ton of cash. It's high margin mining. It'll throw off a ton of cash to allow us to actually then access the rest of the, well, whatever you're going after, 3 million, 5 million ounces, really, really highly efficiently. Is that as simple as that?
That is one of our options.
Right.
Is to do exactly that. We could build it, use the cash flow to then, continue to aggressively drill. The other option is all of our institutional investors are very supportive of what we've been doing, from a drilling perspective, from a de-risking perspective. So, continuing to fund the company to drill is the other option, and that's something that we'll continue to evaluate as we move along.
Okay, good to see you, Ben.
Yeah, good to see you.
Good luck with it. I mean, so you're also here at a conference, Africa focus, Africa asset. You're meeting investors. I get it, but who else are you tapping up?
Yeah, so we're meeting with a lot of investors. A lot of government officials are here as well. So meeting with a number of them, and then a lot of corporates. I mean, one of the things that's kind of stood out this year compared to last year is there's a renewed interest from a lot of kind of business development teams for a lot of these corporates who are now all of a sudden, given the mandate to go out and look at more projects and look at growth. So we've been meeting with a lot of those types of groups as well.